So now we're looking at AMD, Harold, and you have an option trade idea for us, an unbalanced iron condor. So walk us through this setup.
Okay, so when we look at AMD and like NVIDIA, we had that gap up, but it's holding that gap. Now here's where it makes it kind of tough to trade it. Do you want to buy shares? What's gonna happen? You've seen the last week or so, the stock has gone sideways, which is good. And this is where a iron condor can benefit from that sideways movement. But I've skewed the iron condor for a bullish bias to the upside. So it's got the benefits of an iron condor for that sideways movement, but it's got a little bit of bullish bias to the upside there. So that's the reasoning behind this trade here.
Great. And, every option trade should start out as a good stock trade. So you want to make sure that you have your thesis there, you're analyzing the chart. And now let's go on over to Thinkorswim, Harold, and look at the option chain together to set up the strikes for this iron condor. And then we can come back to MarketSmith and take a look at the break-even points to put things in perspective.
Right. Okay. All right, so you should be seeing my option chain here. So we're looking at AMD. I'm going to go out to the July 21 expiration. That's 42 days out. That's 42 days for expiration. So I click on that. So I've got puts on this side. Your calls are on this side. So I'm going to start out selling the 110 strike here. So I'm going to click on that, selling the 110 strike. I'm going to buy the 105 for protection there. So that's the put side. On the call side, I'm going to go further away from at the money. So you see the at the money is basically the stock price. So AMD is around 125 right now. So 125 is there. So what you're going to notice is that this strike, so the 110 strike, is closer to the at the money than the strikes I have on the call side. So the call side, I'm going to be selling the 145 put call, I'm sorry, and then buying the 150. So it's a little bit further away from the at the money. So that's where the skewed part comes in. So the closer you are to at the money, the whatever strikes you have, that's where the bullishness comes into play. So if you look at the option chain here, so again, selling the 145 call, buying the 150, and then on the put side, selling the 110, and then buying the 105, and that's going to give us a credit. Right now, $1.60. It's changing here, so I'm going to raise this to match the math that I have on the right side to 163, so $1.63. So let's take a look at the numbers. I'm going to hit confirm and send, and so here are our numbers here. So the max profit is the credit that we receive. And then the break evens, this is important here. So this is our break even. And you can use this as your stop loss too. So keep these numbers in mind here. So I'm gonna just write that down, 108.37 and then 146.63. So when we get to the chart, we can kind of identify that on the chart. So now what we're gonna do, we're gonna look at the probability of success and how much money should how many contracts should we employ? How much capital are we going to employ on this trade? Let me hit edit here, and I've got some numbers here on the left side here. So our probability of success. So we first need to determine what is our actual risk in this trade. So we take the width of the spread. It's $5 wide on each side. You just take the difference between the strikes. So it's $5 wide on each side, minus the credit received. That's going to give us our actual risk of $3.37, or in option terms, you multiply by 100, so $337. That's the actual risk that you've got in this trade. Now, to determine the probability of success, we just take the actual risk, which is $337, divided by the width of the spread. That's going to give us a probability of success of 67.4%. I like it when you can get more. Well, I like when this number here is higher than the days to expiration. Don't have an explanation. I just like seeing the numbers that way. So how much money are we going to apply to this? So based on our account size, so I just use a number of $2,500. So what you use is going to be different based on your account size, your level of risk, etc. So,
and I want to pause you there to
mhm,
figure out that you want to look at what your portfolio risk is. So if you're willing to
right,
risk 2.5% of your overall portfolio, then that's how you would back into that number.
right. So that 2.5%, that's going to be the figure that you're going to use here. So in this case, we're just using $2,500. So we're dividing the $2,500 by our actual risk. We're going to buy 6 contracts. I'm going to change the number of contracts right over here to 6. And then we're going to look at the numbers again. So again, this is the buying power. So this is the actual risk. It's not going to be exact, but it's going to be pretty close. Then of course our max profit, and then the break even numbers here.
Here,
So
and I want to write down those break even. So
okay,
108-ish and and change, and then 146 and change, just so when we go back to the chart, we can
right,
look and see how much room we have for
right.
that stock to move.
Okay, so I'm going to send this trade off, and we'll see what happens. And now I guess we can take a look at the chart, see what that break even is.
Absolutely. So I will take back over. Thanks so much, Harold. Okay, so 108. So the break even on the lower band is going to be right here. The high from a couple of days ago, that was only 130. So 146, it's like you said, there's a
That's
bullish bias to this, right? So it could
right,
go as high as 146 and still be in that profit zone for this trade.
right, exactly. So we've got a lot
Fantastic.
of room to the upside.
And then Harold, when would you make the determination to close out the position?
I like to manage the trade. When I say manage, make a decision as to what I'm going to do. When we get to 21 days, 21 days to expiration. So we're starting out at 42 days to expiration. So we've got about another 20 days before we can make a decision as to what we're going to do with this trade. I'm going to either close it out or maybe let it run a little bit more. Depends on, uh, a lot depends on how profitable I am, or is the trade working, or is it not working? But that 21 days, that's the key. 21 days to expiration, that's when I'm going to make a decision as to what I'm going to do with this trade.